Okay, in this video I'm going to talk about a little bit about the basic about the balance sheet. When you see a balance sheet, the first thing you look at the top of the balance sheet is the assets. In this balance sheet, there is assets for 2011 and 2012, and as you can see, the first thing that will be coming into assets would be your cash and the bank balance at what you have, and this is the cash and the bank balance for 2011 and 2012. Then there is account receivable. What is account receivable? Means that the money you have lent to somebody and you are going to get it, or the sales you have made it, or something like that, and you are going to get this money back from some parties, and this is what is known as the account receivables. Okay, then we have inventories. And inventory is your something that is lying down in your storeroom, which you may be using for the processing of the finished goods. Okay, that's what is called inventory, and that is also actually considered as assets because it is still have not been used, so it is still it is considered as an assets. So these are the total three assets, and then you come up with the total current assets. You add up all the three and you get a total current assets. Then if you have a factory, you may be having a plant and equipment and machineries, and you can put it as plant and equipment and machineries here, and you can put it and the similar in the 2011 2012. And then there is accumulated depreciation. Depreciation is something that the assets value decreases every year, and you are allowed to charge the depreciation on the machinery depending upon what depreciation method you use and what your organization use, and depending upon the percentage that is applicable to your machinery. Suppose if you had a $100,000 machinery, and if the 10% straight line method was applied at the 10%, so every year you 10,000 to the depreciation value of the machinery. Of course, there are different methods of depreciation using depreciation on the machineries, but I am not going to go into it. And then once you want to take the net fixed assets, you actually subtract the depreciation from the plant and equipments, and you will get the net fixed assets, because that depreciation value means that the value has been used by the assets, and the assets value have been decreased by that amount. Then is total assets is total current assets plus net fixed asset equals to total assets. You get it. Now liability is something that you or the company owes to somebody else. Okay, now this is accounts payable, that the company has to pay something to the other, maybe to the person from whom they have bought the inventory or something, other goods or services or like that. Short term note payable, this is again to be given to this other people. Other current liabilities, this is again a liability which has to be, there are many other description that would be coming into the current liabilities, other current liabilities, which cannot be put into the one single category. They put it in under current liabilities, other current liabilities, sorry. So that is coming here. So all add up, all these current liabilities, accounts payable, short term payable, and you get total current liabilities. Liabilities is that the company owes to the outsider and they have to pay to somebody. Then long term debts. Okay, maybe the company has taken a loan and he has to pay back, and it has taken a loan for maybe 10-15 years, 20 years, something like that, for to build up to buy a machinery or something, and this is the long term debt the company has to keep on paying or has to pay it. Total liabilities. So this comes to the total liabilities. If you see, this is the total liabilities as you will see it. Then we have common stock. Common stock was the stock that the company issued to the shareholders. They issued the shares to the shareholders, and this is what actually would be the common stock, that is people, it has sold the stock to the people and they have got that much money. This is also a liability. Okay, then there is retained earning, and another type of liability that is there, means that the company has kept the earnings for themselves, and that is retained liability, means they have to pay back something to the company or to the shareholders or somebody else, depending upon the situation. Total shareholder equity, that comes to this one, to this amount, and that's it. This is so simple. This was just a basic of the balance sheet. There's a much more in the balance sheet, but this is the basic. Thank you very much for watching. Bye bye.